Hello guys, glad to have you on board again. Today, Thursday, means we're talking about intermediate level briefings today. That's the second, and we're gonna keep on this pace. I really enjoy doing this now, like much more focused content and really much better in terms of educational purposes. So, today, for the French guys, I just decided to talk about accumulation context, and I think it is about time to get to explain this one as well for you guys in English. So let's sum up the core basis. This podcast is meant for green guys, though either white guys really close to become green or green guys close to become yellow will obviously be right into this targeted people. So, alright, broad thing, if you're already yellow, just don't give a shit about what we're going to say today, or it's just going to be like a reminder. Normally, you should already know about what we're going to say today, alright? If you definitely want to have a look, like I said, okay, for yellow people to have a look at the green podcast, just take that as a consolidation of normally previously managed knowledge. All right, you should know at least 90% of what I'm going to be saying today. Anyway, so remember that the goal when you're green and heading into yellow is it's exactly what I told you yesterday in the educational podcast. Your goal is to focus on practicing, and learning new fucking contexts, learning new patterns, all right? Though normally you already master and trade it well without doubts and stuff like that, you're really confident with the range trade. Normally that's exactly what you need to master as you're green, which means the range trade, you've been doing it so many times, all right? You know how to highlight those trades. You can easily get in there. You don't fear trading those things anymore. Like you see a third range boundary, all right, you go straight ahead, you risk manage, you do the drill. You know how to apply that goddamn strategy. You finally get to understand the fuck is these context channels, those trend channels, how they move relating to each other. You do understand the multi-time frame purposes and stuff like that. Normally you've traded enough, definitely not enough to be mature in trading, all right? You're just maturing as you get green. It's just you cross the first step. First step is that you finally let it go with switching strategies all over the place. You're just finally stood with this one, which is great. Even if that's not mine, I don't nearly give a shit. Just follow a fucking strategy and stick to it. This strategy must teach you how to trade ranges more than trading trends. All right, you first start to trade the range. That's, even if it feels like the most chaotic structure, that's the first one you need to focus on. Though learning ranges, and now you're going to start trading the trends. That's how you get there, right? First you trade neutral ranges. I remind you that if you take your little piece of paper, which is your guidelines to safely get into trading and into subjective stuff, remember that yellow is all about subjective things, but in order to get there, you need to get to be rational and not subjective. In order to get to trading and to understand how risk management works, you need to have rules, black and white, yes or no answers. All right, stuff that you don't have any personal bias to put in between. This is why I give you sets of rules, just for you to accept those fucking rules first, master them, and then you'll learn how to break them. But first, you need to master them. If you want to break the rules before mastering them, you just don't get it. All right, so getting green is all about surrendering and accepting that you need to follow rules more than anything else. Though this is the rule, you master the neutral range, great. Now start taking a little bit more risk on those ranges eventually. But what you need to be doing instead of doing this is learning new patterns. So you're green, fine. Now start trading the range, the trending range. This is just a little bit more aggressive. It needs and it requires to have a bias, which means you need to have a fucking conviction about where the market is going to go next. But normally you've got a much better bias than you had when you were white, simply because you've been trading many ranges and you have been seeing normally enough market moves to somehow understand these multi-time frame layers I told you about. Though when you think one time when will very likely move to the upside, though probably uptrend, then that means you should have clues of that uptrend move in the higher time frame. And if you have clues of potential bullishness on the higher time frame, then you can try forecasting the lower time frame to eventually build up an early trending signal, which is the accumulation, all right? Though that's what we need to be doing in here. As you guys get green, make sure that you start having a little bit of biases. I don't ask you to forecast the market, nothing close to this. Just have a little bias. When you are in those ranges, just try to be a little bit more bullish or bearish depending on what you have on the higher time frame. It's really important, all right? And as you do have this, you're going to exploit that. Though, instead of trading neutral ranges, you're going to trade trending ranges instead, all right? As this is going to be new to you, or at least not matured enough to be mastered, you divide the leverage by 2. That's absolutely necessary that you follow those rules. That's the rule number 1 into applying and seeking for new context. Reduce the fucking leverage, at least by half, or even more if you feel like you really need to build up confidence before really exposing yourself to those trades. So, now that we've got the core rules, all right, you understand that in order to trade the accumulation, you rather like to learn the trending ranges first. But the trending ranges are just a slight modification of the neutral ranges you started with. Though I'm not going to make an entire fucking show about trending ranges because this is pretty much the same, all right? Though you just apply those rules with obviously lower expositions just to make sure you're safer. And first, you just use larger stop loss just to make sure that use the largest possible stop loss. Remember that in the trending ranges, you just use the same rule, right? You take the size of the trend channel to define the stop loss sizing, all right? Though you apply that same rule, all right? But you don't try to limit the stop loss. You put it at the size of the trend channel, and that's it. All right? And the maximum on the trading range, sorry, I'll give you the tip, all right? When you get to trading range, to get into a trading range, all right, the maximum stop loss is below the previous low, all right? On a trending range, you don't break the previous low. That's the rule. Though, you take the trend channel sizing to size the stop loss, but the stop loss must not be any further than the previous low or previous top if you're trading a bearish trending range, all right? Simple as that. So that's a rule you can add out of the usual type of things. So you, for example, if you were taking the trade in here, just have a look at the fucking trend channel and it's freakingly large, right? Like, god damn it. All right. The trend channel in here sizes approximately this. Oh, sorry. Trade is this, all right? So, for example, in here, your stop loss should be set in here, right? You don't put the stop loss in here. Like I said, maximum price for the stop loss is the previous low. So this is where you'll put your stop loss in here, all right? Remember, in terms of position sizing, ranging trades never ever risk more than 2%, and that's really when you've got an exit, a tough signal that you'll get to take that much risk. Though, consider that the average range trade you're going to take is 1 to 1.5% risk taking when you master that shit. So as you don't master them, divide it at least by 2. I strictly recommend you don't take any more than 0.5% risk on those trades that you don't yet master. All right? You know how to calculate the position sizing. I'm not going down this road in here. All right? So now that you've made your trending range, oh, sorry, gotta move. All right, sorry about that. So, where was I? Yeah, accumulation trade. So the best way to start and go ahead of an accumulation trade is to forecast a trending range. It requires anyway that you got a conviction, or no conviction, that you got a personal vision of whatever is going to come next. You're going to be either proven right or wrong. We don't nearly give a shit. It's important that if you figure out a bullish trending range to build a bullish accumulation ahead of a bullish trend, you must be feeling like this trend makes sense. If you feel like the market should go down, just exactly, I'm taking the SPX as an example in here because that's the easiest way to forecast a potential accumulation trade. That's the first one I basically came across. But the thing is, in here, I don't nearly believe about a bullish trend, though I'm not going to follow follow those rules. I don't personally trade that, but still, if I was bullish orientated on the US stock markets, I would eventually forecast an accumulation to set itself in here. For many reasons, all right? Like I told you, the accumulation trades has a checklist, all right? It has its own checklist to figure out in order to get to say, all right, I don't know shit about if it's going to happen or not. All I can tell is that it's likely going to happen because I've got the structure I know, all right? That's what you need to be doing about accumulation. So if I was bullish, I would definitely say, all right, we might have a fucking accumulation in here because of these reasons and stuff like that. So I'm going to uncover the entire process. The first process is you need to have a fucking bullish bias. You need to see a trending range working itself up, okay? So in here, as we forecast a potential bullish trend, we're going to do this, all right? So remember the rules, all right? Trending range, which means you go from latest bottom to top. The market must go from context to context, all right? So in here we had a first range boundary, right? The first typical range in here. The market was terminating a bullish trending move, though in here you were targeting a bearish range, all right? So you had a first opportunity in here, but no signal. So either that's a risky trade just out of the target, and basically you sell. You don't risk manage, but you're stopped at break even. Here you got another trade, all right? This one is risky. We've been breaking. This is yellow stuff. Sorry, I shouldn't be going down this road. So in here, there is a tough bearish trade to take. The market in here is divergent in terms of momentum, so you can try yourself out in here, all right? You try this one, you'll be risk managed, like you'll be validated and stopped out. So another range trade that doesn't go along the way. But anyway, we make new highs, which means as we broke the previous range boundary, all right, then the range count just goes back to 0. So here's your first range boundary. And in here, bam, back to context, which means second range boundary has been built in here, and we're looking for the third. So you've got another range trade to take. If you have a bullish bias, go for a bullish range, a bullish trending range. All right, which means we've been making new historical highs. If you still have a bullish bias, then go ahead, try to make a bullish range. Though you would have started looking for an entry out of 61%, all right, as normal people will have waited for 76% fib and below context, all right? Both cases you would have bought in this area, all right? Let's consider a big buying entry. In here was just a taking profit structure, so not really the best case scenario. You use, just like we said earlier, the trend channel sizing in here, and if you trade that as a neutral range, your stop loss in here. If you trade that as a bullish range, your stop loss is in there, all right? We've summed up all those information. The next step is not about it. The difference between neutral ranges and trending ranges is how you manage confirmation, all right? The validation is the same for both. It's like you get in here, you touch the trend channel, your trade is validated, your stop is at the market top, at the market bottom, all right? You limit your risk. Then what comes next just depends on the markets, all right? Like, anyway, if you were trading a neutral range, then you're simply targeting this area, which is the 76% fib, and you're out, pure and simply. If you're trading this as a bullish range, your targets differs. The confirmation in here doesn't come with breaking 50%, it comes with touching the opposite trend chart, the opposite context. So this is where you get confirmed, this is where you risk limit. You start taking partial profits and stuff like that, all right? And this is where the difference starts to stand, which means in here at that stage, all right, either you have reached target number 1, which is reaching out the opposite boundary, all right, and your target area, which is pretty much in here, all right, but normally in there, you can still lock on some gains, but remain partially exposed to the market. Like if you follow the rules in the PDF manual, and I think I have to change that, I've been not really logical in here. You take another 25% gain if you're aggressive, no more than that, all right? And I said entire taking profit for both moderate and low risk profiles, but I don't stand for this. I would pretty much say 25% for everyone in here. That would be what I would definitely do normally. And what the fuck have I done with the taking profits? Oh, damn it. I really need to work out this PDF manual. It doesn't nearly make sense. I don't understand, you guys haven't been seeing this so far. I don't know if I made a mistake as well for the English purposes, but that's definitely not how it works. All right, anyway, Damn it, what the hell have I done? All right. Basically, when you reach out the target, I would say reach out confirmation is 25% profit for everyone, despite eventually the low risk profiles that can go up to 50%. When you get target number one, which in this case, both are in the same place, all right? Your target number one as well as your confirmation trade is definitely in here. So you would take 50% in this area, I would say, all right? Meaning that you're still halfway, you still have half that position open in the market. So this is the best case scenario for you to try making the accumulation trade, which means you'll be able to risk take without financial risk taking, because you already have 50% of the previous position in the pocket, which means you're just going to reinvest those gains you took in here into the accumulation system. So now let's get into the accumulation checklist. All right, so accumulations are always preceded by bullish ranges if you are bullish accumulating, or bearish ranges if you're bearish accumulating, which means any fucking way you couldn't have broken the previous range boundary. All right, so you need to have higher low. All right, higher low or equal lows, but anyway you can't have gone anywhere below there. Eventually some cases can be done with an ugly lower shadow candle, but no candle closes below the previous lows. All right, like you can dip a toe lower, but the market shouldn't nearly stay there. All right, though higher low or equal lows like double bottom structures are okay, no more than that. All right, the market must have retraced up to the resisting context. All right, so we're going from context to context. That's absolutely necessary. All right, the context must be bullish orientated. It always will be the case. All right, most of the time it will be the case. All right, so you bullish orientate this context. All right, sometimes it will be bearish when you reach out to it. Okay, so it feels like the context does something like that, and then you must reverse it bullish. Okay, so the accumulation must reverse the context. That's necessary prior to that. Then, generally, as this is a trending context, all right, this is early trending, this is the first step of a trend, though you must follow the entry condition of the trend. So take your piece of paper and have a look at this. In trending ranges, entry conditions are minimum 23% retracement, and if you're beginning, not really familiar with trending trades, I'd suggest you take 38% fib instead, simply because you're going to miss some trade with the 38% rule instead of 23, but you will also be on safer trades, which means you'll probably miss a few trades, but you'll be having higher level of risk limitation by using 38. So always go for the safest when you just start learning a process. So I suggest first 5 accumulation trades, go for 38% prior, then switching to 23. Then you need a signal close to the trend channel, and this signal must be colored and possibly with a triangle. All right, so that's the best case scenario. Sometimes you won't get the triangle or something like that, but normally you should have that. All right, so the thing is that that's what you would be looking forward for. In here, the triangle still is not there, but you've got the rest. All right, you've got the blue signals. The blue signals is the oversold cluster is okay in this purpose, which means you're overselling out of the trend channel. The other rule I'm going to teach you in here is just a tip, but typically accumulation structures tend to retrace between 38 and 50% of the previous movement, which means you take the previous swing, all right, which is this one. All right, though in here the Fibonacci's, the automatic Fibonacci's are plotted from top to bottom, so they're plotted from here to here. All right, but for now you're going to take this one. All right, simply because those Fibonacci's will update, which means if we make new highs in here, they will update, but as we fail to make new highs, they're still plotted out of the previous tops and bottoms. So anyway, that's just one thing. Though in here you plot your Fibonacci's manually, and you'll figure out that normally in that market condition, the market generally gets to, most of the time, accumulations are between 38 to 50%. So the typical, the statistical introduction for range is for accumulation is generally there. So in here something definitely goes wrong. Remember that accumulations must be done out of trend channels, definitely no context channels. So in here going in this area would mean going into the context channel, though not an accumulation. All right, so in here, if we were about to be bullish in Wall Street, then they'll have to pay the 23%, simply because they can't go anywhere below. So that's now. They need to buy now if they want a bullish accumulation. And remember what I said, I don't believe that we're going to have a bullish trend in Wall Street. Eventually I'll be wrong, because technically speaking, there is a context for bullish accumulation. I don't nearly believe it will work out, but that's a personal bias, all right? Like I told you, don't trade trending trades if you are obviously not convinced, sorry, but not convicted. That doesn't nearly make any sense, sorry about that. So if you're not convinced that this market may be bullish, that's the problem. Remember, to me, there cannot be bullish trends simply because we terminated the fucking weekly trends. Though I stand to believe that we're going to retrace those trends more than anything else. I'm eventually going to be proven wrong. If I am, I'll just be wrong, and it happens. That's no big deal. Like I told you, I mean, if Wall Street just fucks me up and creates another trend to go higher, I'll be wrong and I'll have no context to trade. Though, what am I going to be doing? Nothing. That's pure and simply what I'm going to be doing. If Wall Street prove me wrong, I've got nothing to trade. They will just be absolutely irrationally trading. And guess what? I'll let them do. They can be irrational. I don't nearly give a shit. All I can tell is that the consequences will be there because you can't do something without side effects. You can go crazy fucking bullish, but when it will go down, it will be just worse. That's simple as that. But they can go higher. I don't believe they can, but they still can. All right? I'm not making the market, and my personal beliefs are definitely not making the market move. All right? Remember that you might think whatever the fuck you want. The most important thing is that you actually put some rules in between your beliefs and your actions. All right? Those rules are patterns and stuff like that. Anyway, back to our context. All right? If we are about to have a 4-hour accumulation in here, and if Wall Street actually buys the 23% retracement, what do? First of all, if you're new to accumulations, you don't trade that. For the reason I told you, you're going to wait for 38 to 50%. There's another rule I'll give you. If you go anywhere below 50% with candle closes, I mean, like getting 61% retracement, that's not an accumulation. We don't accumulate out of 61% retracement. This is the cluster area for accumulation, 38 to 50. Some rare cases, like this one eventually, will retrace just 23%. It's rare. It still happens. But you rather like to go safe with that rule instead of being aggressive with this one. You will eventually be aggressive in the future when you really master those contexts and you get familiar with them, right? When you're comfortable with a context, then you can be a little bit more risk-taking with this context. When you're learning, go safe, right? So in here, if there is an accumulation, what is the next step? Okay, we've got everything we need for accumulations. We've got oversold cluster, which are possibly trending signal, because when you're overselling, not making new lows, means you're exhausting the bearish momentum without breaking any significant level. Though this, like I said, the problem in here is that this is not the first overselling context. Right? That's really one of the things that in here lead me to believe that something goes wrong with this market. We're looking for overselling multiple times in a row. Every time we do, makes a new low, makes a reversal, which means bulls are trying to recover from bearish excessiveness, all right? But so far, we're not breaking resistances anymore. Look in here, we oversold, but we failed to break new highs. We tried, we really tried hard, but we failed. And we've gone lower, and now we're oversold again. The bulls are trying to wrong foot us one more time, and I better hope they fail. And now we're going to gain some bearish momentum, because I think the next time we break down, it's going to be significant breakdown. Though remember, I told you to trade this one, all right? I told you get in here, put your fucking stop loss there, and let it go, all right? Because if we fail to get in here, that means the bears will gain control and the bulls will lose control, which means we're probably going to have a little trade on the lower time frame, in which we're probably going to fuck up some support. Where's the next support? In here. So if we go bearish, the next stop is below that price. Though that's a pretty drop, all right? It's not crashing the market, but it's going in there and it's going to feel painful for the bulls because they'll certainly not support prices, all right? Though they better hope, bull guys certainly hope that we hold on to this area long enough for them to be strong enough to be strong again. But I'm sorry, until yesterday's move, we're still having control as bears. So they better hope we're going to lose control, just like I hope they will lose control. That's a battle. We're both right, actually. One of us will end up being proven right in the end on the overall scenario, but in the short term, it's bears defending this area, bulls defending this one, and we're just dying in between. Right? And guess what? We're purely dying 50% of there. So we still don't know where to go. Right? Bulls are fighting up, bears are fighting back. That's exactly what we want. That's exactly what we have right now. Anyway, so if accumulation is there, next step is going to the resisting context. All right, remember that accumulation, that's something I've been telling you so many times, is oscillating between context and trend channel. There can be many contacts, all right, like we can go trend channel again. The accumulation structure can be varying a lot. It can be trend channels, it can be bullish wedges, it can be triangles, it can be many structures. The goal in here is that the market holds on to the trend channel, never goes back to the support context, all right, and always get to reach out the resistant context anytime it makes rebounces. All right, so as long as we do this, the end is that simply, normally, the market, instead of going back for the trend channel, will basically this time stop and break up. All right, like the final move prior to the breakup is generally the market not reaching out to the trend channel and generally breaking up throughout both the trend channel and the context channel. That's a typical accumulation trade. Normally, you already know those rules. You hear me talking about it so many times. But the goal is, how do you catch this? Like I told you, the rules are really simple. Minimum 23% retracement. For beginners, go 38. You need to have the trend channel and not the context channel in there. You need to have a trending signal and a triangle. Though in here, you don't have the triangle, you still have the trending signal, though it's a partial trade. You could eventually take that if you're really familiar with accumulation trades, because you would be trading 23% instead of 38, and you would be trading without the confirmation signal, which means you really need to master that context if you want to go down this road. Certainly not the first 10 of your accumulation trades, but you must have traded them many times already, so you're familiar with that context, all right? You've been doing this all over again. You can risk take because you know how to risk manage. That's how you get yellow. You know your context, you've been trading them enough, though you can take partial trades. Just because you know there is something in here that can happen, you have partial signals, which means you're still lacking confirmation in here, but you can still try to get in there. You know how to do this normally as your yellow. I'm not going to tell everything about it in here, but when you're missing signals, all right, in here I'm specifically talking about the greens that are really mature and getting closer to the yellows, or the yellow guys that get in here to confirm their knowledge. You know how to deal with partial signals, all right? Partial signals means higher risk, which means if you want to reduce the risk, you need to pull it somewhere. So how do you deal with that? Normally you know your shit, all right? You know that you have to go on the lower time frame to figure out if there are risk limitations in here, all right? So that's how you deal with it, all right? Do you see a risk limitation in here? Yes, there is. So if you wanted to buy this area, you could have done it, all right? You could have done a partial accumulation trade in here by risk limiting with those oversold clusters in this context. But it would have been risky any fucking way. Just look at the context. They're both unfolded as well. So I would say okay, but really risky. Though I don't really think the market is bullish. Personally, I think the market is just trying not to be bearish, but it just takes a spark to fuck it up. All right, that's exactly what I think it is. Like Trump trying to save the market with his usual bullshit, but the market news being pretty much negative. Like, we've got nothing from China. And he said the deal could come sooner rather than later. What the fuck? I mean, can you do even more subjective things than that? So it's just as stupid as ever. Nothing from the Chinese. They've been running away earlier than expected on the last negotiation round. So do you really think that's bullish? No, that's not. There's no deal down the corner. It's just the usual Trump bullshit. We're on support area, he tries to save the dip. That's exactly what it's been doing all over the place. That's really stupid. Like I told you, accumulation, but the problem is, if we're not accumulating in Wall Street, if we're distributing instead, Oh, yeah, I'm going to talk about that. That's important for you to figure this one out, and then I'll stop there. All right. No, sorry. Before going about distribution systems, all right, let's talk about another stuff. All right. So once you've been taking your accumulation trade, you're going to be great to trade the breakout. Simply because if you took that trade, all right, let's assume you've been taking 4 contracts in here. All right, let's put 4 hours for 4 arrows for 4 contracts. All right, you've 50% profit taking here, meaning you sell 2 contracts. What you're going to be doing in here as you're beginning is that you're just going to put those 2 contracts back in the market at the beginning. All right. All right. If you take this trade, and remember you can't, you should have waited for this area. We're just taking this as an example. All right. So you put back 2 contracts. As you'll get more familiar with this context, you'll get to add a 3rd contract. Okay, simply because that's how calculation works. So this is pure yellow content in here, but I'm going to go down this road anyway. For mature greens only in here as well. All right, though let's assume 4 contracts, 2 contracts, and in here you put your stop loss in here. Stop win. That's exactly what's written on the PDF manual, which means you've got gains, guaranteed gains. Though I suggest you reinvest the gains you've made in here plus the gains you have there in here. So you don't take more risk, you just reinvest it all, which means if the market goes there, you lose it all. All right? It will happen sometimes and you'll be, damn, I'm pissed off, I had guaranteed gains and I just lost it all. Great, no worries, all right? Like losing a gain is not a loss, but instead, you risk take, which means if it goes well, you'll make much more money because it goes parabolic. The more risk you take prior to a trend, the more rewarding that fucking trend will be. All right, let's explain that. All right, we got 4 contracts minus 2, which means you've got 2 contracts. If you take just 2 in here, it means at the breakout, you'll have 4 contracts running with a paid stop loss and whatever. You're fine. All right, though in that context, even the most aggressive profiles can't reinforce more than 100% position sizing out of the breakout. All right, at least not before being really good. I mean, like I told you, I've made 100% reinforcement for moderate profiles and stuff like that. I think that's too much. I might have to rebalance this thing. But 200% for very aggressive is what I do on the most aggressive things. All right, when I really believe that trend or whatever. But most of the time, I suggest you take 100%, which means in here, 4 minus 2, 2 contracts plus 2 contracts, you've got 4, which means you're going to go from 4 contracts to 8 contracts when the breakout occurs. All right, so here the breakout goes on. So you had 4 contracts, you're adding another 4 contracts, and you're putting the stop loss below the accumulation level. All right, you're rising the stop loss in here. Okay, and you have 8 contracts going on. Now, if you do it different, like 4, 2, and in here you put 3 or even 4. Now you have 6 contracts, which means instead of 8, you're going to have 10 or 12 contracts in here. All right, with the same stop losses area and stuff like that. All right, so obviously the more risk you take on early trading activity, the more expositions you will have on the trend trade. And when the trend trade triggers, then you just let it go. Afterwards, people will be, oh, damn it, good, we've got a trend. All the breakout traders will show up, but you'll simply just let the gains pile up without any more risk taking, because in trends, either you go lower time frame to reinforce if you want to be even more aggressive, or you just ride the trend, let it go. All right, that's easy, that's simple. You've got gains, recurring gains coming day after day in the account, and you just patiently wait for the divergence. All right, you know the deal. All right, on the next videos I'll eventually get down the pullback trades, but I think for today is more than enough. So let's sum up the core informations and the checklist you might have to do in order to accumulate the market. So first, you need to have a conviction. All right, you must have room to go to the upside on the higher time frame. That's absolutely necessary. All right, so your conviction, you need to have higher targets reachable on the higher time frame, and you must not be on a mature trend already, which is where I think we have a problem with Wall Street. All right, I don't see any more bullishness possible because we already terminated a bullish trend. So if we go any higher, means we are going out of typical trend management, which means we go bubble, all right? But like I said, going bubble nearly is not impossible, right? We can very well do it. It's just, I better hope we don't, because the consequences will be disastrous. But anyway, we can do it, all right? Like, we already have a credit bubble. I already told you that we can have an ugly asset bubble on top of it. That will be the worst case scenario for the entire not even stock market. In here, the consequences will be disastrous for people, all right? But anyway, not going this far. So in here is where I personally think this scenario doesn't work, but still, I could be wrong, all right? This is subjective. Anyway, the next thing is that you need to have a validated bullish range building itself, though high or low, all right? You must not break the previous lows, and you must have succeeded going from bullish context, from support context to resistant context, all right? So in here, that's what we have, all right? The bullish range is somehow validated. The accumulation is retracing, minimum 23% retracement, hopefully 38 to 50. In here, not yet, but we could go there, all right? Is not reaching out to the context, all right? So trend channel, but not the context, is absolutely necessary. The next step is prices going from trend channel to context. So that's the next move for the bulls. They want to push us back to the resistant context. We're still not yet there. Could be, all right? Like I said, you never ever anticipate the future. You never ever, yes, we do anticipate the future. That's exactly what trading is about. But we don't forecast whatever is going to happen. We just risk limit what is the most likely thing to happen. It's just this, just about it, all right? But anyway, that's how you deal with it. If you can cross all those things, then you know the accumulation is setting itself. You know that you are very likely going to have the next one, which is the breakout. Either bullish or bearish, all right? But you're going to have the trend trade triggering right after this. When you've got those structures setting itself, bullish ranges or bearish range, followed by accumulation, you know the breakout is very likely going to show up after. All right? Anyway, so now that we're done with this, sorry, I just forgot what I needed to say right before. So anyway, that's no big deal. Oh yeah, accumulations and distribution. Though, accumulation, all right, is where we prepare for the trend. All right, you heard that word, sorry, many times in the past. So I'm just going to explain you what this is. Accumulation is what prepares for a trending move. All right. The next step is the breakout and the trend trade, which means everyone sees that one of the two counterparts is losing strength or even not trading at all, which means a bullish trend means the bears are not selling, not enough bears, though the bulls take it over pretty rapidly and easily, all right? Just as a bear trend means no buyers, and no buyers means just a few sellers can move price rapidly as well. It's the same opposite direction, an opposite system. But the thing is that there is a lack of demand for one counterpart. So accumulation is like exhausting one of the counterparts. Like this is exactly what's happening right now. We could be accumulating because the bears are getting exhausted of fighting the market without getting success. So it's a binary choice. Either we are just gonna be proven right with a very dangerous structure, meaning that the market just fucks up instantly, and I told you that if the bears succeed, it's not going to be pretty reversal. I really told you it's gonna be ugly, it's gonna be dirty, but it's not going to be conventional, all right? Because any fucking way, the bulls are really, really feeling strong right now, so they're going to have to be wrong-footed. If I am right, the bulls will figure out they were wrong all in the same time, though there will be an ugly bearish trend trade to validate my scenarios. Option number 2, I'm wrong. And if I'm wrong, then I'm going to just exhaust myself over and over again, trying to sell the market without success. And at some point, I'll stop. The day I'll stop means the bulls will be easily breaking any resistance, and they will basically rise prices just like there were nothing. They can rise price because no one is selling in front of them. Right? If we go down this road, I told you the trend is over, which means we can go higher because nothing can stop us. All right? Nothing's impossible. But the only structure that can lead us to new highs is an ugly weekly bubble, and a weekly bubble in Wall Street with that much depth. I don't know what's coming next, but I can tell you one thing: it's going to be deflationary. So if we go higher with that much level of debt and an asset bubble that big, because we're going to create a bubble out of the SPX basically, so we're going to create a bubble out of the US valuations. And if that happens, I can tell you just one thing, the dollar is ended afterwards and it's going to be deflationary for probably 20 years. And if that happens, you definitely don't want to have dollars in that world. Not now, right? That means you can have money in dollars for the next couple of years or whatever, but the next crisis and the moment the bubble will burst will destroy so many dollars that it cannot be anywhere different but deflationary. Deflation means simply the opposite of inflation, all right? So many people don't think it can happen because it hasn't happened for 50 years. Then just learn a little bit of history and you'll figure out that it happened and it can very well happen again, that we're exactly into the kind of context that can create deflationary pressures, which means afterwards, if you get that, then cash is king, simply because there's so much cash circulating in the country that no one wants to take debt, people want to pay their debt. That's simply destroying money. And it goes with bankruptcies, people not paying their debt. And if it ever happens, let me tell you, that's really not pretty at all. Though I don't think it's going to happen. I stand for this. I don't think a bubble is down the corner. I can be wrong, and if I am, I'm not going to fight that bubble. And you really need to understand that as well. You don't control shit. And as you're green, you might still think you do, and that's a great danger, all right? You control ranges, and that's great. You at least have a little bit of control over something, and that's an illusion. Like I told you, control in trading is generally an illusion. You'll figure out later that this is an illusion, but if you feel like you're controlling, then don't put overconfidence in your trade, all right? You're just managing something. The only thing you do is risk managing in a range. That's exactly what you do, and that's great. That means you can manage trading ranges. Now you can eventually start managing trading accumulations, breakouts. I'll teach you pullback the next time and stuff like that. All right, you get into multiplying the context you master just so you can risk manage in those areas better than the average, and you'll pick more money. As simple as that. All right. Though accumulation, like I said, precedes a trend. Distribution is the exact opposite. The distribution is the end of a trending structure. That's exactly what I think is happening right now. Like I told you, smart money accumulating entries early trending cycle, early economic cycle, and they're doing what? They're distributing the fucking gains, though they're selling at the end of the trend. That's exactly what I think is happening, though this is why I don't nearly believe an accumulation is setting itself in here. I think they're distributing, which means anytime the bulls gets excited, they're selling harder, pure and simply, until the bulls are exhausted instead, which means sooner or later we should see bearish accumulation instead, all right? Which is the moment in which those guys who are selling don't buy on the support. So the bulls feel pretty weak, and that's where I think the accumulation will set itself. If I'm right, oh, sorry, I'm not going to use those tools, damn it. All right, if I'm right, the next stop is going in here. I think it's going to be done ugly, all right? So we can spend another couple of weeks or even more weeks in here accumulating, deteriorating prices. Whenever we fuck up this area, the bulls will figure out they're fucked. At least they'll say, all right, we don't trade this area anymore. We're going to try support prices in here. But I told you, when we go there, this is where it all starts to play. I don't nearly believe we're going to find some support in here. I think this is where we're going to accumulate the bulls before fucking them down. That's what I think, all right? Am I going to be right, wrong? Tell me what you think. All right. Actually, I don't nearly give a shit. I mean, you can think whatever you want. I totally respect other people's biases. Like I said, if some people are bullish, they might have their own reasons. I have my own. But anyway, no one's going to convince me I'm wrong until the prices do prove me wrong. It's simple as that. I can be proven wrong, like I said, and I won't be surprised if it happens. I'll just be disappointed because, like I said, it's going to have consequences. We're not talking about short-term trends. No one nearly gives a shit. We're talking about altering weekly pricing, which means it will have economical consequences afterwards. And I better hope we don't go down this road because I know where it leads us, and it's not going to be pretty. But anyway, if that's what the future is about, like I told you, I have my own perceptions of the market. I could be even wrong with that. But if I'm right, and if we go down a dangerous path, and if it ends up being ugly, then I'll just say, what the hell, why did we go down this road? We could have been doing something less violent in between, all right? Anyway, that's it for today. See you later, guys. See you next week. Next week we're gonna try talking about pullbacks or anything different. Right? It's just depending on the context I can highlight. I'll do the shows depending on what I can talk to you about. But today I'll just show the SPX, and I just thought myself, all right, there's eventually a bullish accumulation setting itself. If they hold on to the current area, they'll try doing it anyway. That's definitely the goal. If the bulls manage to hold on to some support in this area and reach out to the resistant context, then I'm going to be stopped out. No questions, all right? And I'm not going to fight against that. I'm just going to let go, all right? And we could have an ugly bullish accumulation attempt. I'm not going to trade it because I don't believe in that, all right? I don't pass the first rule. I don't have a bullish bias, though I'm not trading this accumulation. That's simple as that. That's a personal vision. That's a personal bias. Like I told you, I might be eventually not profiting from a very rewarding trade. Still, not losing, no losses, it's not losing. I might be missing a trade. Like I told you, if you feel painful for this, then you're definitely not mature enough, right? I don't give a shit. I might be missing a trade. I don't believe in that trade. I'm not taking it. Simple as that. There's many opportunity elsewhere. So being right or wrong, you should really stop giving a shit about that. All right? Later, guys.